Today, this time is different. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Another Friday evening, and guess what? Tarric Brooker's with me. Hi, Tarric.
G'day, Martin. How are you, mate?
I'm extremely well. How are you going?
Yeah, pretty good. It's nice to see your studio is coming together. It looks like the backdrop from something like one of the major news networks, and well, we're back with a lot to talk about, so I'm very pleased to be here.
Yeah, the technology is now pretty much complete. I've had a real nightmare building all of this technology out, but hopefully, the technology now slides into the background and we focus on the content. And boy, there's a lot to talk about, right? And things are definitely different this time, aren't they?
Well, they are. I mean, we've seen the move from the Bank of Japan to alter its yield curve control with its cap on its 10-year bond yield being raised from 0.5% to 1%. And then we've also seen, the downgrade of US credit, US government debt by Fitch, now losing its AAA rating. And, there's also the fact that we're seeing an upsurge in listings of US long bonds as, the tax receipts fall and the deficit rises once more. So it's very much a very different sort of set of circumstances to where we've been recently, and perhaps a little bit more to the way things were back in the day.
Well, certainly rates higher for longer, but also I think that the Fitch comment coming in line with the with the US Treasury uplift in terms of their expectation of future debt highlights that there is a bit of a debt problem in the US potentially, right? And, as with all of these things, I think the markets sometimes underreact to some of those things and then perhaps take it on board later. But it is a really interesting time. I reckon, you could not have had a more fascinating journey over the last couple of years with everything that's going on. But I think the takeout for me, Tarric, is the aberration of ultra low rates is gone away. And it's probably never going to come back.
It's going to be interesting to see if they can, bring it back and under what circumstances. I mean, I guess it's in the long run, it's going to be possible. But I think on the other side of the coin, there is, as we've discussed before, that addiction to stimulus, that addiction to intervening in markets and intervening in the economy. I think that we saw during COVID that's very much something that has now become a widespread expectation, particularly in sort of more affluent Western countries, places like the US and places like Australia. There's this idea now that that Albo or ScoMo or whoever it is in power must now come to the rescue. And I think you're right that is going to really complicate the sort of return to what we would have considered normal in terms of low rates, prior to the pandemic, but now we're going to see those forces once again pushing back against each other. So, we could see that, sort of burnout economics future that we talked about in last fortnight's show.
Yeah, the burnout show got a good hearing, and a lot of people said, hey, that's a really important analogy as to what's going on. And, I find it fascinating that the Fed is doing quantitative tightening, whilst the US Treasury is, wanting more money, basically. And then if you put the Japan context over the top, because of course, until very recently, with ultra low rates in Japan, a lot of that money flowed into international markets. But in fact, if Japan then moves rates up as well, the liquidity story and the demand for, US debt in particular could actually move quite significantly.
It definitely could. I mean, Japan is one of these countries that has a persistent current account surplus, which basically means that they are a net lender of capital out into the rest of the wider world. And that has been the case now for decades. Even during Japan's lost decade, it was still, exporting capital, so to speak. And I think that the Japanese story and the impact of the Bank of Japan's changes is really one that's a bit underappreciated. I did an article on this in quite a bit more detail, which I'll get Martin to link in the description. But I think what's really interesting is just that there's this idea that, you look at things and you go, well, why would I buy a Japanese government bond at 0.65 or 1% or, for over such a long duration. And the reality is that the headline numbers don't matter too much. What matters is how they are relatively once you've accounted for things like currency hedging or other forms of investment products that make it possible for Japanese households, Japanese corporates with additional large balance sheets to invest in the rest of the wider world. And the thing that we're seeing at the moment, and this has been one of the headwinds that US treasuries have been facing for a while now, because of the volatility in the currency markets, particularly the USD Japanese yen cross, those hedging costs have gotten a lot higher. So even though American bond yields have risen quite significantly, they were actually more attractive a couple of years ago when the hedging costs were lower. So with the Bank of Japan now raising the cap at which yields can rise to, Japanese bonds are becoming more and more attractive to Japanese investors, which is going to see them increasingly preferring long duration Japanese bonds over similar US bonds because of that hedging cost.
Absolutely, yes. You could certainly mix up the markets quite substantially, and of course, what's happened because of the Fitch downgrade and also the Treasury in the US needing to get more money. That's lifted long-term yields on bonds, or price of bonds dropped, and that's putting now a bit of a dent in the bond market as well. So it's like, well, okay, what does this mean then for the stock markets? Because of course the stock markets have been priced for perfection, and the last couple of days they've come off a bit, and it's sort of beginning to wonder about, in my mind, as to whether we are now beginning to see the next phase in the story of the evolution. And whilst the central bankers are on holiday in the northern summer, they don't really come back to September. I think things could be quite different by the time we get to September.
They could. I mean, there's talk now that if we see a hot jobs number later tonight, that a September rate rise could be on the cards for the Fed. I mean, I believe I looked earlier in the week and they were talking about a 20% chance of a rate rise. But I think that, as we see, the bond market evolve, as we see this new equilibrium being found following the Bank of Japan's abandonment of its 0.5% target, I think we could just really see an evolution, as you said, Martin, and the new equilibrium found in the bond market of where long bonds sit. And even, we could see the front end of the curve, which is where, interest rates, overnight interest rates, the Fed rate, the RBA rate, we could see those dragged higher as well. So, there's very much interesting times ahead in that regard. And, just to touch on Australia very briefly, Australia is one of the, has for a long time been a beneficiary of Japanese capital flowing into Australia in search of higher returns on savings, whether it's in an account, in just a regular old AUD savings account, which has been hedged into yen, or it's been Australian government bonds. But if we do see a return to volatility in terms of the Australian dollar, those hedging costs go up, and these Australian assets are just losing a bit of their luster. So there's implications for that for us too, not just in America.
And if you then overlay the question with regard to the Chinese economy and the weakness there, and the stimulus that they can and can't do, or will and won't do, you've got to say that a couple of the big economic supports for the Australian economy could be going away. And that, of course, again, has profound implications for the local economy. One of the reasons, perhaps, why the exchange rate's a bit weak at the minute.
I think ironically that the exchange rate is actually still quite significantly supported by these ideas of Chinese stimulus. I think if we sort of really saw, that the headlines disappear, and that that the People's Bank of China and Beijing more broadly were actually happy to just sort of tinker around the edges rather than do this kitchen sink that's kind of sort of expected in especially in some commodity markets, I think that the Australian dollar would be quite a lot lower, and so would a lot of steel-making commodities in particular, things like iron ore. But I think it's going to be interesting going forward, because there was an interesting interview with the CEO of China Beige Book recently on CNBC, which is well and truly worth watching. It's only about 2 minutes long, but what he said was really important. That basically that there are elements of the Chinese economy that are performing very well, and that there are elements of the Chinese economy that are performing very poorly. But because of this bifurcation in outcomes, you've got, say, for example, the travel sector, um, affluent retail, eating out, all that sort of thing doing rather well, and then you've got other things at the other end of the spectrum performing very poorly. It's not enough for them to just turn around and do the normal kitchen sink construction driven stimulus. There isn't enough impetus for them to do that under the current conditions. So it's really a bit of a perfect storm for Australia because we're not actually linked to the broader health of the Chinese economy. There is a scenario in which the Chinese economy powers ahead based on consumerism, and the traditional drivers such as construction, real estate, property, etc., all fall away, and our economy falls to bits, even as China powers ahead. We aren't the sort of one-to-one proxy for China that we used to be. While we may be in terms of our currency for a time, in terms of our economy, that story has really changed and evolved quite a bit over the last few years.
Well, that's right, and that's why I have a feeling that some of the valuations on some of the Australian stocks are probably overdone. And I look at the iron ore price, and sort of it's knocking around 100 US if you look at the Singapore exchange, and the forecast is it could slide a bit further. So there are some very significant open questions, and of course the statement of monetary policy that the RBA came out today suggested that inflation will slowly drift down, but not in the short term, and interest rates, even a couple of years into the future, will be higher than we've been used to, although it might be a little lower than where they currently are. All of those things are predicated, I think, on a relatively steady state Australian economy. But if in fact those international forces start bearing down, the local economy could be quite a lot weaker, and that might then force the RBA to cut rates even more. And the risk of a recession is probably still on the cards.
Well, I think you make an interesting point because one of the things that was in the RBA's change forecast was that they believe that the economy is now only going to grow at 0.9%, which, if you look at it in per capita terms, is flying backwards at a great rate of knots. So I think that that doesn't really leave us a whole heap of wiggle room going forward if things were to go a bit wrong. And looking around the world, you've already got places like Germany, places like New Zealand, already having experienced recessions. And, there's some models out there from the Fed and from others pointing to like an 80, 90, 95% probability of the US economy falling into a recession sometime in the next 12 to 18 months. It really puts Australia in a bit of a tight spot in that regard, because if those economies start to slow, China doesn't stimulate, we've got a bit of a problem in that regard, because our consumer economy is only going to continue to slow. Although, it really may come down to what ends up happening with the immigration forecast, because that's the particular avenue that is being pursued to avoid a recession. Just bring in more people, and if the population grows enough, a recession basically becomes a statistical improbability unless the wheels really fall off. So we're just going to have to see what the immigration intake looks like for the rest of this year and this financial year for 2023, 2024.
Well, I certainly don't see any appetite for reducing the immigrations, certainly from the political perspective. But of course, the implications in terms of crowding, rents, housing supply, all of those other factors are pretty profound. And of course, you've got the other question, of course, that GDP per capita, which is probably the better metric, probably the most significant metric, as you say, goes even worse, because effectively our productivity is very low in Australia and falling away further. And by the way, it's also productivity is a question in the UK as well, and some other countries too. So this is part of an international conundrum rather than a local conundrum. But I do get the sense that Australia is quite well exposed to some of these things. So maybe Phil Lowe isn't actually too disappointed to be walking away from his job in September. Maybe it's quite good timing.
No, I mean I mean, he gets to ride off into the sunset, doesn't he? You know, he gets the golden handshake and walks away with millions. So, I mean, I don't. I mean, I got to say, if I was in his position, I wouldn't be complaining. But I think you make an interesting point on productivity. There was a chart on that in the RBA chart pack. I think it was yesterday, and you know, things are not good in that regard. Productivity per capita is well and truly going backwards at a great rate of knots, and you know, I mean, I just think it's interesting because we've had this enormous expansion of the labor force, and now productivity is going backwards per capita terms. And I just think it's like, you know, I think there needs to be a discussion of, is that partially down to the quality of labor that we are importing? Obviously, there are a lot of skilled people, but there are a lot of people who aren't. So, you know, that's a discussion that needs to be had, but probably won't be. And, you know, I think that naturally that's another key going forward for, you know, because if we can't get productivity fired up, trying to get real wages growth fired up is going to be a real problem going forward.
Well, I think Phil Lowe's right, because he said consistently that productivity is the key. If we don't get productivity up, then we can't make the economy work for everybody. But I don't see a vast number of policies coming from the government with regard to productivity. I mean, it's difficult to do, right? And even all the investments in technology and AI and everything else that people talk about hasn't actually succeeded in lifting productivity particularly well. So for me, it's the big conundrum, and it becomes effectively the economic question of the moment, because without it, I'm not sure where the the exit is.
Yeah, it's kind of a bit of a dead end in that regard, isn't it? Because if you have rising wages without productivity, then you get margin compression and you eventually get job losses, you know, and basically no one, you know, you end up with a contracting economy and no one ends up happy. So, you know, we're in a really difficult set of circumstances in that regard. And I mean, one of the things I thought was interesting was one of the charts from another chart from the RBA chart pack was just that you're starting to see some of the wage pressures, you know, in some of these private wage indices come off the boil a bit. Now, that hasn't really been borne out in other things, sort of like the AIG, various PMIs in terms of wage pressures. They're seeing record high wage pressures, but you know, I think that, you know, wages is really going to be one of the major important stories for Australia going forward, because we've got to dig ourselves out of this hole where we've lost, you know, something like somewhere between 14 and 15 years worth of real wages growth already.
Yeah, it's interesting in the UK, teachers just settled above 6% wages growth over the next year, and other wages pressures are very, very strong, and that's one of the reasons why the Bank of England lifted the rates again by 0.25% yesterday. And their charts show that they expect wages demands to peak a bit and then ease back a bit, but still be very strong. One of the reasons why they've got still a concern about inflation. So if in fact wages in Australia are easing back, it might give them a little bit of wriggle room. On the other hand, of course, they've also got an expectation unemployment will rise, and even in their latest numbers, they're still looking for higher unemployment ahead. So it's going to be tricky.
It is, and I think the thing is that it's going to be challenging, just in the sense that, I mean, I think it was ANZ's chief economist, might have been, or someone senior at ANZ, I believe. They made a comment on Twitter a few weeks ago in which they said that the labour market needs to create 32,000 jobs a month just to tread water and for the unemployment rate to not rise at this point. So that kind of puts us in a very challenging position, because creating 32,000 jobs, or, you know, well over 370,000 jobs a year on a sustained basis in an economy like Australia's is very, very hard. So eventually that's going to bite, even if even if job creation stays relatively strong at a relatively, you know, positive point where compared with historically, there's just, the labor force is growing so quickly that we are going to see unemployment start to bite for, you know, tens of thousands of Australians, probably, in all likelihood, I would say probably by the end of the year.
Yeah, it could happen quite quickly, I think. And as with all those things, we'll be watching. Now, the good news is that we've got the integration of the studio complete, so we can move pretty much directly onto the slides with just a push of a button.
Yeah, it's great. We're really cooking with gas. As usual, folks, the charts are available at avidcom.substack.com. There will also be a link to that in the description. If you would like to support my work there, that would be very, very much appreciated. And it just sort of helps me keep the lights on while I'm doing all this sort of other stuff. And we'll get right into it. Now, what I did recently was I went through all the various major rate cut cycles by the RBA, and then I compared them to when the Fed did the cut rates the same. So what I found was that the RBA doesn't really like going it alone. Over the last 30 years, in 3 out of 5 rate cut cycles, the RBA either cut rates first or they cut rates knowing that the Fed would cut rates at their very next meeting only a few weeks later. The only times that they did cut rates outside of that was in 1990 and then in 2011. And in those cycles, the RBA cash rate was in a different galaxy to the federal funds rate, which gave them a great deal of scope to be able to move on their own. But with the federal funds rate, so the Fed rate, now 1.4% higher than the RBA cash rate, their ability to move on their own without having significant implications for the Australian dollar and the potential to import inflation, well, it's curtailed quite a fair bit. And there's some very real downsides if they do choose to pursue rate cuts significantly ahead of the Fed.
And what's important about that, of course, is that the Fed and the Bank of England, and indeed the ECB, also said higher for longer. In other words, rate cuts not coming anytime soon. And again, there are some commentators who say we're not sure we believe that. We think that it's more likely that rate cuts will happen more quickly. But on the trajectory that the Fed and the other central banks are talking about, that could put a very interesting point of pressure on the RBA, who are, as you say, behind the ball quite a lot, significantly behind the ball compared with everybody else. And of course, that does have an impact too on the exchange rate.
Exactly. And I think that, there's this idea that, all these other central banks are going to out-hawk the Fed. And personally, I don't think it's going to happen. I think we've already seen, rate rise expectations get very much adjusted in places like Europe. Even in the UK, we've seen that, even over the last few weeks, it's gone from we're heading to 6% to no, we're not. We're heading to something a hell of a lot lower than 6%. And I think we're going to continue to see that, because we're even starting to see some central banks around the world, such as the Reserve Bank of Brazil, cut rates. So I think that we are going to see, other central banks blink first, but these others, the thing is, for say the ECB, they're on a different playing field to Australia. They're backed by what is basically on paper roughly the largest economy in the world. It's sort of a challenger for the US in that regard. The UK has the UK is on roughly the same path as the US, maybe a little bit higher. Canada is on roughly the same path. And so that leaves little old Australia with our significantly lower rates, with our significantly less strong system that doesn't have those reserve flows that some of these other larger economies do. That leaves us in a much more vulnerable place. So, I think this whole idea that, rate cuts ahead, everything's going to be easy breezy is, well, it's a bit hopeful, shall we say. And I'm not saying that it's impossible, but just that there would be costs associated with pursuing that course.
And I wonder what that would do also to the international flow of funds, because it seems to me that quite possibly what would happen is that investors would prefer other markets rather than Australia. And, I would argue that Australia has been seen as a proxy for an investment in China without some of the risks till quite recently. But that could be changing, which means that it might be harder to attract investor flows into Australia. And if that were the case, that could put significant pressure on a lot of things within the country.
Absolutely. And I think that it's really worth noting that, that the Australian sovereign is in a pretty good place in that regard. We've got relatively low levels of debt, and despite the fact that there's this sort of implicit, explicit, whatever you want to call it, link between the banking system and the federal government, it's considered pretty safe and pretty attractive. But where we start to really run into some difficulties, even at this relatively early stage, is state-based debt, because the states have a lot less power to gather revenue, a lot less power to tax than the relative to the federal government. But they've also got the responsibilities of having to take care of education, transport, and healthcare. So they're still having, and not only that, but the requirements for those particular government spends only continues to rocket due to immigration. So, and obviously an aging population. So they're really in a tough spot. I mean, we saw that recently with, the cancellation of the 2026 Commonwealth Games in Victoria. So, our states in a lot of ways, depending on which one you're talking about, are in quite a bit of trouble.
Yeah, absolutely. Well, I think the state story is absolutely where the focus will be. The debt's very high there. They've still, of course, got overhang from COVID. And as you say, their ability to be able to raise additional revenue is, well, pretty limited.
Yeah, and I mean, to me, one of the big ones was when Victoria sold off the licensing arm of VicRoads to the private sector. I mean, you don't sell off something like that unless you really, really need the cash. I mean, there's still money for fishing rods in the budget, but we'll leave that to the political critics, or once we have our political critic hat on, maybe in a couple of weeks. But I think that it just goes to show that that we've had really badly managed budgets here in Australia. We've had this idea that we could just keep going and going and going on the never forever, and we can't. And while there are states, say like Queensland or WA, which have these large inflows from mining royalties and other various beneficiaries from the resources sectors, a lot of the other states don't. And they are also dealing with, the impact of immigration far more than a lot of those other states are on a more long-term basis.
Yeah, and just quickly before we go on to the next slide, I will make the point. Last week I mentioned a question mark against MMT, and I did make the point that it depends entirely on where you put that investment. If you create liquidity using MMT-type philosophies, if you invest in the right things for long-term growth, it might make sense. But if what you're doing is essentially simply using the money to make up the current budget and cover current expenditure in the normal course of events without making the investments into the future, then what you're doing is building a bigger hole for yourself. And that, of course, is what happened because we haven't had the strategic dividend from such investments. And that's why I'm a little bit skeptical of the idea of using it. If it was done properly, it could make a big difference, but it wasn't done properly.
No, and that's something that you and I have been talking about now for over probably about at least 3 years.
Absolutely.
Yes, can it be done? Can it be done from a sort of, academic, scientific perspective? Yeah. To a degree, sure. Will it work in the long run? I don't know. I mean, I think we need to explore it on a sort of more small scale before we implemented something like that. But I think that we've seen that, that it's one of those strategies that works very, very well on paper, but then when it's implemented and it faces contact with human reality of greed and political opportunism, that it just falls apart. And I think that's true of a lot of different philosophies, to be honest.
Well, and of course the higher interest rates. So the cost of debt now is dramatically higher. So you could argue that there was a purple patch opportunity when ultra low interest rates were in vogue, where if they'd actually grasped the nettle and actually grabbed some of that very cheap money, they could have done some very significant strategic investments for the future. They didn't do that. And now interest rates are a lot higher. And of course, if you go look at the US, the debt burden there, that means that a lot of the money that's being generated through the tax system is going directly to pay the bonds that are there. So the economics have changed dramatically.
No, absolutely. All right, on to the next slide. Now, this is an interesting one because it basically just shows that US households are now much, much less exposed to floating rate debt. Now, unlike the GFC, where they're about 25% of US household debt, which was also significantly higher than it is now at the time, about 25% of it was adjustable rate. These days, it's more like about 12%. So US households are getting hit much, much less hard from rising rates than they were previously. And I'm just going to move on to the next slide because this relates to this. But the actual net cost of of higher interest repayments versus the impact of higher rates and people getting higher returns on savings and other investments, there's not really that much in it. Households are not really being put out to a really great degree by higher rates. So the lag between the time that the Fed raises rates and the US really starts to slow down is significantly longer than it would have been in past cycles, even though there is a lot more debt today than there was in, say, 2008.
Yeah, that's very interesting. And there's a big debate going on in the US at the moment about the lag, long and variable lags, many people are arguing. Other people are saying, no, actually, you don't understand. With all the things and the structural changes in the economy, actually, the impact has already come through. So there aren't any lags to wait for. And of course, depending on which side of the fence you're on that will determine a very different strategy in terms of, inflation targeting and interest rates. My own perspective is, and what I'm seeing, is that there are lags and they're taking quite some time to come through. And the fact that more people have fixed rates rather than variable rates is a significant factor. But I also make the point that now more people are grabbing credit, particularly in the US, for example, and I think here in Australia as well, and I see in other countries too, to try and get by. So there's a lot of big questions about lags, or a lot of lags, and I find it fascinating because the ECB lifted, but in their committee they were actually three-way divided. There were some who said, no, keep the rate there. Some said 25 basis points. Some said 50 basis points. It's fascinating that even those in the committee can't quite work out what's going on.
No, I mean, I think part of it is wishful thinking. We sort of just hope that we're going to be able to muddle our way through like we usually do, and as we have over the last, let's call it, last 15 years. But I think it's easy. I mean, the truth is this happens every cycle. Every cycle, you look at the New York Times or you look at the Wall Street Journal, and I'm talking about cycles going back, almost a century. And they're talking about, the soft landing, that somehow this time is different, like the title of our show. And the thing is, this time in some ways things are different. Things have changed. But that doesn't necessarily mean that we're going to get to avoid, the impact of the largest and fastest relative tightening cycle globally or in US history since tightening cycles began. I mean, perhaps I lack imagination, but I struggle to see how that's not going to eventually weigh on things. Now, I think the thing is, there's also the fact that, that the Biden administration has been running a, frankly, wartime level deficit this entire time as well. I mean, you saw that surge in tax receipts in, sort of towards the end of start of 2021, where you saw the impact of all those various stimulus measures feed through and then feed back into the US government coffers to some degree. But now you're seeing the deficit re-blow out again. And, we're back at, like sort of start of World War II level deficits in terms of the deficit to GDP. And I think that's a really underappreciated sort of factor in all this, because if we were running a pre-COVID level deficit, say the average deficit between, say, let's call it 2014 and say 2019, the US economy would be absolutely in the toilet.
Absolutely, it would. And it is fascinating to just understand the quantum of debt that's there. And I always put it in the context, too, of not only the public sector debt, which is huge, but of course, corporate debt has grown dramatically over recent years. And corporates now are also being squeezed with higher rates and, trying to figure out what to do. So there is a very interesting question about whether the credit will go flowing or whether in fact the credit will get tighter, and if it does get tighter, how the liquidity drought flows through. And I suppose the public sector and the governments always have more ability to raise debt than the private sector, but liquidity I think is the key question. That's what I'm concerned about at the moment. I think liquidity could well be a little interesting question in the next 12 months.
It is, and I think that what we're seeing at the moment is a lot of corporates, even large corporates, a lot of them are pulling back on these bond issuances, these bank loans, because the costs have risen so significantly. I mean, I'll just go to the next slide because that relates to this. And what we've basically seen is that for the vast majority of companies, the cost of debt has really started to surge quite significantly. Now, this is actual debt exposure rates rather than market rates. This is so, the effective rate that they're paying on their existing debt. And as you can see, for sort of say like 50% of companies, which is the top 10% and the middle 40%, things haven't really been too bad so far because they locked in a lot of these cheap bonds, especially the ones bought by the Fed during the pandemic. So they locked in these very, very low rates, and they're now reticent to issue a lot of new bonds at these significantly higher rates because they're obviously going to be paying for that for years, if not decades to come. Excuse me. Like recently, there was some headlines that even Apple, which is one of the AAA rated companies, was now seeing its 30-year bonds trading at yields over 5%. Now, that's a real seismic change. I mean, 30-year bond yields on Apple bonds have roughly tripled from where they were during the sort of the flight to safety during the pandemic. So, we are seeing those rising costs feeding through. And while a lot of these larger companies can hold off because they built these enormous war chests of cash during the pandemic, as you can see for the bottom 40% of companies, and these are still, huge, $100 million, $200 million, $1 billion companies, they are still struggling with the rising cost of debt. And that rising cost of debt is only going to get greater and greater and greater as time goes on.
Yeah, and if I just add to that, certainly from my SME survey in Australia, it is those lower, smaller companies that are actually the most exposed to the higher levels of debt and the ability to get credit. And I think, a different sector of the market than what that chart shows. But it does make the point that, in fact, pretty much across the board, those companies that need debt to survive, a lot of small businesses do, they're having to pay a lot more for it. And that ain't going to change anytime soon.
No, and that, I think, brings us nicely back to the issue of the lags. Because, if you do start to see, and you're starting to see this even today in CapEx intentions and stuff like that here in Australia. There's this in some of the RBA's chart pack. You are still seeing that push for labor, but you're starting to see year-on-year terms CapEx intentions and business investment starting to fall. Now, while the RBA is forecasting that to pick up, I wonder if that's going to end up in the same annals of history books as their wage growth forecast as something hopeful that we all hope will happen, but doesn't.
Hope is not a strategy.
Well, I guess it technically is a strategy. It's just a bad one.
Good point.
But yeah, so I think that we're in for an interesting time in that regard because we're going to see CapEx just fall and business investment just fall off more and more in the US and in Australia. So I think this idea that we're somehow going to avoid that impact and that eventually hitting the economy is a bit fanciful, really.
Yeah, I agree. I think there's a lot going on there. And, if you think about where growth is going to come from into the future, if you don't get business investment, growth is going to be harder to make.
Well, exactly, because at that point it falls onto the government. So, yep. And we all know how that particular story ends. Okay. Now, this sort of feeds in nicely to what I was talking about earlier in terms of how Australia needs to basically create 32,000 jobs a month to tread water because the expansion of the labour force is so large. Now, if you in the yellow there, we've got Australia, and in the blue, we've got the US. So we would need to create a whole hell of a lot less jobs if our labour force was expanding at the same rate of the US as the US. But the Albanese government has chosen its strategy. It's chosen high immigration. So now keeping the unemployment rate treading water and avoiding that potential feedback loop of lost jobs, less economic activity, worsening economic conditions, and rinse and repeat is significantly harder than it otherwise would be. But hey, we get to avoid a headline recession for a little while longer at least.
And of course, it's the headline that matters. Many of the economists don't go very far down the text of what's going on, right? So I find it fascinating actually how there is a lot of focus on the headline, very little focus on the implications and the GDP. But for me, 32,000 a month, that's a big number. The chances of being able to do that. And I think the other question I've got is, what is the quality of those jobs? Because a lot of the people who come in are very well qualified, but there are a lot of people coming in to do, fruit picking and other things like that. So they might be working, but they could be working poor. And that's another factor in the mix here, which I think people often don't actually fully grasp.
Yeah, and I think the thing is we're already starting to see the impact of this feed into the figures, mostly on the underemployment side of things. We've seen this in Australia and in New Zealand, where underemployment has started to rise quite significantly because people are now no longer there is such a demand that we're just going to go, oh, okay, we're going to pay, an existing resident X amount of money to do this when, there is now labor I can get in from overseas who's willing to do it for less. So, those hours are being cut. And, I think that that's just sort of a sign of things to come. We are starting to see the labor market come off the boil. But I think the ironic thing is that as things stand, we're probably going to still see relatively good job creation in net terms for at least, I'd say, for another, 2 or 3 months, probably longer. But as I said, if we're not creating 32,000 jobs, technically speaking, eventually the unemployment rate's going to rise.
Absolutely. Well, and I come back to the RBA saying 4.5% is probably, a more balanced view, because everyone's trying to work out where that sort of neutral setting is, and it's sort of been creeping up a little bit. So I guess we'll wait to see.
Indeed. And to be honest, I'm not sure where it is. Like, I think that, well, you know what? I think we'll just get to the chart that covers that in a couple of minutes. Months between peak cash rate and rate cuts. Average is 10 months. Longest is 17. Shortest is 3. Now, it's worth noting that this is from the peak in mortgage rates. So, for the most part, this is all 100% spot on. But in 2008, there was some out of cycle rate rises that kept going. So that sort of distorts it a little bit. But I mean, in a way, if you look at this, all the mortgage holders should be rooting for higher rates, because the higher they go, the faster you reach the peak, and the faster they get cut, in theory. And that's a pretty big if.
Oh, I like that idea. So actually, mortgage holders, you should be cheering for higher rates, because the sooner we reach the peak, then they can start coming down again, rather than trying to hang on and hope they don't put them up. Interesting.
Well,
philosophy.
I mean, it's ironic because the clock starts ticking again. Because I mean, the RBA avoided raising rates over the last few meetings, and there are people out there who still believe. I mean, I'd say probably over half of economists still reckon that we're heading higher, maybe more. And I mean, I'm just basing that on the large bank economists and stuff. I mean, I'd say at the smaller scale, there's probably even more. But we are seeing that continued upward pressure on rates. So I think it's going to be an interesting one, because if we do see another rate rise, say the Fed raises rates in September, and then you see an RBA rate rise maybe in October as a result of a relatively what would you call it? A relatively, at least warm Q3 CPI print. Well, then you've got an interesting ball game on your hands.
Yeah, you do. And of course, everybody is saying we're going to be data dependent, which is a way of saying we've no idea either.
Yeah, well, I mean, the thing I think is going to be really interesting is the RBA going to be willing to let the spread between the federal funds rate and the RBA cash rates blow out to an even larger record high than it currently is, with the Australian dollar in such a vulnerable position, particularly if we continue to see bond yields surge as they find this new equilibrium following all the changes by the Bank of Japan. If that occurs, then they've really got to balance things very, very finely, and that could put our new Governor Bullock in quite a challenging position.
Well, that of course implies importing inflation, doesn't it? If we're not very careful.
It does, and I think that there's a fair bit of sort of hedging and stuff and various mechanisms used these days by some of the larger retailers to sort of make sure that there isn't like a major shock in terms of the cost of imports. But given enough time, that is something that definitely weighs. And given that as well, that if you look at things like the NAB business survey, the AIG PMIs, all these other various different indicators in the services sector and as well as goods, you are still seeing, you are still varying by industry, you are still seeing these price pressures. So if you do see, the rising cost of goods coming in from overseas continuing to come up, then these businesses have got a problem, because they either see their margins get compressed, and you should potentially see them trying to cut costs by cutting headcount or whatever, or you see them raising prices further, which then puts upward pressure on inflation. So it's a bit of a double whammy in that regard. So it's something that the RBA really have to try quite hard to get right.
Yeah, and there is this interesting conundrum between producer prices and consumer prices, and it's not necessarily directly correlating at the moment that as producer prices growth ease, that they translate necessarily into consumer prices easing the same way. So there's another interesting little mechanism in there as well.
There is, and I think it's worth noting that the magnitude of producer price increases that we've seen around the world have been much, much, much greater than the ones that have flowed onto consumers. So we have, in some cases, seen that margin compression story play out already. And, it's also the fact that it takes time for these things. I mean, like, there was an interesting chart recently by the RBA, and it showed that about 60% of businesses only adjust their prices once a year. So this isn't something that happens instantly. This is something that happens on a relatively rare basis for a lot of businesses. So it's something that takes time, and that there are lagged effects that come in, over quite a protracted period. Especially if you got someone who's a bit of a sort of, I mean, I don't know what you call him, but someone who's a pragmatist, or even someone who's just a bit of a nice bloke who just doesn't want to jack up his costs, doing whatever it is he does. Mm-hmm. He just wants to give people a bit of a break. And then eventually you get to a point where it's like, well, I've given people a bit of a break, but my costs have risen X amount, and now I have to pass it on.
Absolutely. Yeah, well, the whole question of pricing and putting up prices is quite interesting. And I see in my business surveys a number of businesses saying, well, we haven't yet put the prices up, but we're probably going to have to, because eventually the elastic stretches too far and they've got no choice. Yeah,
and I'm not sure if you saw it, but I think it was either in the RBA chart pack or the statement on monetary policy. I forget which one it was in, but there was a chart that showed intentions of companies to raise prices at a rate higher than they currently are, or a rate lower than they currently are. And one of the things I thought was interesting about that was, it's all well and good to look at that and go, well, inflation is going to come down. Well, yeah, it is, because, you're not going to have 7 or 8% inflation all day, every day. That's just not going to happen. I mean, at least not in the way we currently measure inflation anyway. But I think it's just worth noting that quite a significant proportion of companies were still planning to raise prices by more than what they are this year. And, I think in some ways that we're going to see these increases in public sector costs, things like council rates, and you're going to see a little bit of a, well, if they're jacking up whatever service it is by X cost, then why can't I?
Yeah, I think that's exactly right. And it tends to be a little bit sort of self-reinforcing as it goes up. And just a sidebar, of course, the ABS this week published the living costs data, which I made a show on earlier in the week, which showed that actually real living costs were significantly higher than the CPI. Well, there's a surprise, huh?
Yeah, I'm shocked. I mean, all you got to do is look at the non-discretionary inflation number in the CPI, and it's not a pretty picture.
Yeah.
I mean, and then we've got all the people, going around saying how fantastic it is that Albo's raising the rate of welfare payments, even though it's just what's linked to the CPI, and it's actually less than what's going on in discretionary inflation, and a hell of a lot less, again, than what we're actually seeing in terms of rising rents.
Absolutely. Well, the rental story, of course, is a big part of it. A few others there as well. And interestingly, of course, that the CPI doesn't have mortgage costs, whereas the living cost ratios include mortgage costs. And guess what? Costs have gone up, what, 95% or something stupid? I mean, it was a huge number, wasn't it? Over 90%.
Yeah, I just remember, you know what? It's funny us talking about this because I remember us having a conversation about rising mortgage costs. And I think I was referencing an article I wrote back in October 2021. And I said, and you and I, and I think we mentioned good old Roger Brown old mate bank customers saying, that there was a very real threat that mortgage rates could go up and that we could see, mortgage repayments really, really surge.
Yep.
And we copped all sorts of crap
Absolutely.
for, being doomsayers and everything else. And now, the ABS is like, well, they've gone up by 95%. And it's like, well, vindication.
Yeah. That's why I'm sitting forward in my chair. It's all the arrows in my back.
Yeah. Oh, I hear that, mate. All right, we should probably move on to the next slide. This is the various wage measures that were in the RBA chart pack, and basically, I think it's quite interesting that if you look at things like SEEK, the household survey, the RBA liaison, even CBA's wage indicator, they're all showing some concerning signs of coming off the boil. Now, while obviously we'll see a nice surge in the next set of wage numbers as a result of the increase to the minimum wage and award wages, I increasingly have doubts that we're going to be able to sustain these wage increases to a point where they're going to be able to, really challenge some of the larger increases that we've seen in Europe and the US.
Now, I think the interesting point on that is that, of course, these are averages, right? And what I'm seeing in my surveys is a very interesting distribution. There are definitely some households who are doing really, really well in terms of wage rises, but there are a lot of others who are not doing well. And if I then do a sort of cross comparison between those with high levels of mortgage stress versus those with low levels of mortgage stress, what I'm finding is that a lot of those with the high levels of mortgage stress are unfortunately the same people who are not having anything like the wages growth that on average is not too bad. So there is an interesting conundrum, and it goes right back to what we keep saying about the K-shape or this bifurcation in the economy. Some doing well, some doing not well.
Well, I mean, there was a little bit of a heat map chart from the RBA, to reference them again, that showed, sort of what sort of various different workers were getting, distributionally. And something about like 40% of workers, even on some of, their liaison group, wage metrics, was still seeing their wages only, 40% were rising by less than 3%. So, which is, well below the 3.8% that we're seeing in headline terms. And, I think in some ways that's just a lot of data in general, where you often see things like the average income, which is distorted higher by, Twiggy Forrest and Gina Reinhart, and all of a sudden, the income of everyone on the street is $1.5 million, even though it's nowhere near that based on the average. But I think it really distorts things, particularly with wages, because this is a discussion that you and I were having, prior to the pandemic, when wages were absolutely in the toilet for a lot of people, and only less than half of people in any given period were seeing a wage rise. So, I think that there is a real danger that we return to that particular set of settings.
Well, particularly if companies are actually not able to generate the margins on their sales. Sales are down, retail's down. Again, it goes right back to the tide is sort of coming out a bit, and unfortunately, there are going to be some people stranded on the rocks.
Indeed. Speaking of retail sales, I had a few people ask me after the last set of retail sales numbers to do a set that is based on volume. So this is inflation adjusted, and to do it in per capita terms, because obviously we've seen quite significant population growth, not only since COVID, but also prior to the pandemic. And this is retail sales per capita and the trend line is from 2017 through to the start of 2020. And I think it just shows that that the retail sector in this particular terms is still performing relatively okay. We still are seeing, and I think it's also just worth noting that a lot of consumption was brought forward during the pandemic because everyone was stuck at home. Everyone went out and bought a television or a new couch or all manner of things, things for their home office. So the fact that it's still up by about 5% in per capita terms is, I think, actually still pretty decent. So there may still be further to fall in that regard.
Yeah, I think that's very interesting. And again, this is average, right, per capita, right? Again, if you were to split it by cohorts, I think you'd find that the story was remarkably diverse, that there are some who are definitely hunkering down. Again, I see that in my surveys. Others doing pretty well and still feeling that they've got plenty of capacity to spend and spend big. So, we're in this sort of situation where not everybody's equally being caught by the draft.
Yeah, I mean, absolutely. I mean, like if we look, we just, move on to the next chart, just which is obviously not adjusted for population growth. Even on those terms, we are still seeing it fairly significantly above the admittedly very weak trend that was there pre-COVID. So I think that, a lot of the psychology has changed in that regard, that we are still seeing these cashed up, affluent groups continuing to spend, particularly, I mean, the data shows that basically that the spending is being done in inflation adjusted terms by households over the age of 55. And that's a trend that we've been seeing in Australia now for the best part of years, even on a per capita basis. So, I think that, as you say, that you are very much seeing that bifurcation and outcomes. And honestly, I suspect that it's going to get a whole hell of a lot worse, to be completely honest with you.
Well, that's right. And one of the things I've been looking at is equity and the equity withdrawal. And guess what? There are still people pulling equity out of their property to be able to support big spending. So that's another little factor in the mix.
Has the proportion of people accessing equity, has that remained, in the highs that we saw earlier in the year, or has it come down?
It's come down slightly, but the amount that's being withdrawn is still pretty extended, and it's certainly higher than it was if you go back a few years. So because of the big run up in prices, house prices, there are a lot of people who are still feeling pretty affluent. And they think, let's go grab a bit of equity and then go spend it, with big holidays or buying another property or whatever it is. And interestingly, there's a little bit of a thing going on there with the Bank of Mum and Dad beginning to bounce back a little bit. So it dropped dramatically.
Really?
It's beginning to sort of go the other way now because there are people who are thinking, well, hang on a moment, property prices might be going up again, so maybe I should try and catch the draft before they go up too much. And so there's, I think, a bit of a short-term turn in terms of the Bank of Mum and Dad as well. So that could actually have another interesting supportive factor on property prices.
Unreal. I mean, if you've got that data, I'd love for you to send through the latest Bank of Mum and Dad stuff. That'd be great.
Yeah,
because I'm really wondering to what degree that's influencing things at the moment, particularly in light of the data you shared with me recently about the renters intending to buy, because I can imagine that a lot of young people are going, quite desperately cap in hand to mum and dad to ask for help to, escape the nightmare that is the rental crisis. And frankly, I completely understand that drive.
And interestingly, with home prices in some areas rising again and the performance of the stock markets as well, there is more capacity now amongst some of those older households to be able to, create a package of equity from those sources and hand it down the generation. So I'm certainly seeing a little bit of a turn again now. It's only started to turn up, but that's literally this month. So last month it was down. This month it's started to tick up again. And my intention data, which is effectively in the next 6 months, are you likely to, has turned as well. So my expectation is we'll see the bank of mum and dad start to move up again, both in terms of the volume, but also in terms of the average amount that's being made available for those with a cash injection.
That's quite fascinating. I have a bit of a theory that I'd like to share with you, just sort of, see if there's any, grounding in your data for it. And, because I've spoken to a few financial advisors, and what they've suggested to me is that there are older couples who are reaching that approaching that super preservation age or approaching retirement, who are, who have been sort of influenced by the pandemic to think, well, I want the holiday now, I want the dream car now, or I want X, Y, and Z now. Maybe as you say, maybe it's a bank of mum and dad moment, but they don't have the money from their super yet because they can't access it, or they're choosing not to access it for some various reason. And what I've heard is that a lot of people are using Equity Mate to get this money a bit earlier. And even though they're having to spend money on, the interest, they're just like, oh, well, my super will make it back anyway. So I think that's sort of like an interesting phenomenon that may be occurring. Are you sort of seeing anything in your sort of your data, or heard through the grapevine anything similar?
Absolutely, yeah, that is definitely a factor that I'm seeing in the data that is coming through, particularly for those below the pension activation phase, as it were, who have got quite large pension balances that they know they can access. And they're also thinking about something else, and that is the context of the equity that you can put back into superannuation when you downtrade. It's a big deal, right? It's 300,000 or whatever the number is, right? And
yeah, each.
Yeah, and they basically brought the age down so more people could access it. That's actually becoming quite a big factor, and it's one which financial advisors have already switched on to now. So that's also in the mix too. So I think you need to look at it holistically in that sort of whole area. Downtrading from major property, equity withdrawal perhaps early, and then equity injection into superannuation later as well as part of the story. And the only trick, of course, is you have to do the 300,000 within 3 months of actually selling the property.
Well, I gotta say, it's a pretty clever strategy. Yep. Taking full advantage of all the various concessions on tap.
Oh, absolutely. There's no doubt that it's one of the best concessions that there are for those who actually have the wherewithal to make access and use of it. And bearing in mind, of course, that many people's superannuation balances are significantly below what they need to be able to actually give you a reasonable retirement income. And especially, of course, if you do have mortgages that need to be paid off as part of the process, there's some quite smart thinking to be done in there, but you need a financial planner to be able to sort of put it all together. And interestingly, I do see a lot of people now saying, well, I probably need to get some financial advice, but I'm not sure I can want to spend money getting it. So that's another little interesting sort of thing that's coming through in the data.
Yeah, the circular issue with financial advisors. I need a financial advisor, but the financial advisor costs too much, and then the government, has all the various regulations that makes it extremely expensive for good financial advisors to get by on their own without, having a parent. So it's a bit of a mess in that regard.
It's a huge mess. Absolutely, it is.
Okay. This is a nice little chart of what happened to the Japanese 10-year bond yield, which is the candle chart on part of this that basically just shows that the moment they removed the 0.5% cap, yield surged. And in the orange there, that's the US 10-year yield. So as you can see, the moment they removed it, and it was made clear that it would be removed, both of them took off. And we'll just go to the next chart. This is of the US 10-year, 20-year, and 30-year bond yields. And basically, all of them have broken out in a relatively spectacular fashion, Stalag 13 style, over the last few days, and they have jumped quite significantly. Now, the question is are they going to find new highs? Are they going to head up towards some of those lofty heights seen in 2008? And there's also the big question of, are they going to break something? Because in the last few times that we've seen surges in these long-term bond yields, as you can see in October and then again in March when they hit those new highs, cyclical highs, I should say. In October, we saw the blow up of the UK bond market and the Bank of England had to intervene. And in March, we saw the blow up of US regional banks. So the question is, what blows up next?
I reckon September is probably when it's going to happen as well, looking at the periodicity. But I was talking to a bond trader the other day who was certainly concerned with the rapid change and movements in bonds. You know, that they'd sort of thought they were reading it right. And one of the observations he had was that there are a lot of bond traders now using options to try and protect themselves because of the level of uncertainty that's just gone through the roof. And I think that's quite interesting.
It is, and I think it also just adds as well to that volatility issue as well, because you do start to see these option trades, these shorts, etc., and some rather stretched positioning, and what we've seen in both directions, I think, over the last say six to 9 months, and we could see further volatility in bonds, which could spread into, it will, if we do see further volatility, it will spread into other assets, and in time, as I mentioned before, we could see it breaking stuff.
Yeah, and I think that idea of stuff breaking is real. And I think I still don't believe that the regional banking crisis in the US is as past as many people have suggested. There was another failure quite recently, and the higher costs that are implicit in these higher bond yields, it's going to make things really difficult for many corners of the market.
Yeah, exactly. And I mean, and it also sort of raises an interesting point, because if this is what yields look like at 0.65 on the Japanese 10-year, if we do start to see yields continuing to rise and we do see the Japanese 10-year rise up towards 1%, well, what are US yields going to look like? Is that going to potentially say we're going to potentially see a synchronized surge in yields around the world and a surge in borrowing costs? And I mean, that would be well, that would be interesting. Let's just put it that way.
Well, it might make Jackson Hole quite an interesting event in a few weeks' time, right? There might be some interesting speeches, although actually one or two people are speculating that Jerome Powell may not speak at Jackson Hole this year, interestingly.
Well, that would be interesting, and I mean, I will say that the Japanese, the Bank of Japan's timing is just absolutely impeccable.
Yes.
They go, it's like bang, we're abandoning yield curve control. Next week, US Treasury turns around and goes, bang, we're going to increase the issuance of long duration bonds because we have to, and because tax receipts are falling, and the deficit is rising. And then Fitch turns around and goes, you know what, we want to join into this complete train wreck, so we're going to cut the US credit rating in while we're at it.
Yeah. And interestingly, yesterday it was clear that the Bank of Japan was letting those long-term yields move way above their previous target, so they're definitely taking the foot off the brake there and allowing the market to move. So I don't think we've seen the end of it yet.
No, and I think it's going to be really interesting in terms of, we're going to see, I think, this stop start move in the bond market, because the Japanese, the Bank of Japan is okay with it rising toward the 1% on the 10-year, but they want it to occur in a relatively orderly, slowly sort of fashion, because they've already stepped in twice when yields have surged to by an unlimited number of bonds to basically stop it from going up so quickly and, really sort of, wrecking the market with volatility. So, I think that's going to be, that's an interesting added dimension, rather than it just going bang straight up to 1%.
Yeah, I think that's right. So watch the level of intervention and control, and watch how the international markets respond. And this international flow of capital between Japan and the US and other markets is one to watch, because I think we sort of called this, it's different this time. Well, this is a good example of it is different this time because of those changes.
Yeah, exactly. Now I think we've got time for one more chart, and this is one that that people quite liked on Twitter today. It's the expiry of fixed rate loans by the proportion of loans expiring. And I think that this is a good one because it shows that a lot of people have said, well, why isn't the mortgage cliff biting yet? And the answer is, in some ways, it is. We've seen that discussed by CoreLogic and the AFR that we are starting to see that surge in listings, not necessarily distress listings, but people who are, sort of sitting down, doing the maths around the kitchen table and figuring out, well, no, we can't afford the mortgage. And we're better off walking away now while the going is good. But if you look at the chart, it's only been in the last 4 months that we've started to see the bulk of these fixed rate loans beginning to expire. So there's still quite a long way to go in that regard. And the people that we're seeing in trouble now, that you're seeing, in various different, either in arrears or in various different surveys, such as Martin's or Roy Morgan's, showing real signs of running out of runway. These people are people who are either on variable rates or people whose loan expired, in all likelihood, either very early in the year or towards the end of last year. We haven't seen the people these bulk of people on fixed rate mortgages get into real distress yet because they haven't had time to. And considering how well this has been telegraphed, you would have to be fairly unprepared to not have done any preparation at all in terms of giving yourself some buffers or reducing your spending or preparing in some way for the difficulties that lay ahead.
Now, very interestingly, Tarek, in my surveys, I'm seeing quite a few people who have taken steps because they know that they're actually up for this. And they've got some wriggle room. And, if you try and tease out, well, how long is the wriggle room? It's about 6 to 9 months. So once they reset, they've got some capacity. So they're sort of banking on the idea that in 6 to 9 months, rates will start to come down, and things will even out a little bit elsewhere, and wage growth will actually also help. That's the bet that they're taking. There are others who are actually now saying, no, we can't wait that long, and whilst we've got this emerging problem, maybe we should think about selling, and that's one of the reasons why listings are beginning to rise. So these are not people who are actually being forced by the bank. So it's not a distress sale in that sense, but it is a sale that is actually being triggered by the expectation of higher rates in the next few months and wanting to try and find an exit route, particularly if property prices are moving up. And that's one of the reasons why we're seeing that. The other factor in terms of listings, we're also seeing quite a few investment properties where they haven't necessarily maintained the property very well and where the rent can't be put up anymore, still not enough to cover the mortgage repayments. What they're doing as a result of that is actually wanting to list those and sell. So that's one of the reasons why listings have started to uptick a lot earlier than normal.
Yeah, I think that's a really interesting one because, this isn't really a time historically where you do start to see rising numbers of listings. It's normally, the winter lull. There's usually nothing until sort of the latter part of August, and you start to see, the 4-week auction campaigns getting put together. So it's going to be interesting to see if we do start to get more of these listings coming to market. And I think it raises some interesting questions about the psychology of potential vendors, because a lot of people are sitting on the sidelines, and I would suggest that the level of turnover that we've seen in some markets has been well below what you would see even in a, for want of a better expression, normal, life happens market. And with the number of listings being postponed, that we could see, a potential, uptick later on in the year. That's something that Edwin and Tom Panos and CoreLogic and a lot of different people have been talking about potentially occurring later in the year. So at that point, especially if we start to see, we do start to see some continued improvement in the situation in the rental crisis and some of that relief spreading in from the regions into some of the capitals, and you start to see that demand that you mentioned coming from the renters starting to pull back a little bit and people being a little bit more comfortable with waiting, then I think we've got a really interesting ball game on our hands in terms of what happens with the property market, especially if the economy continues to decelerate.
I agree. And interestingly, the US, of course, the property market there, the number of listings are way down. And the reason for that is that people are sitting on low fixed rate mortgages at the moment. And so they're just don't want to move because they know that if they do, they might have to go from a higher rate. And you can take some mortgages with you, but nevertheless, the latest intelligence I'm reading from the US is that's one of the reasons why the listings are way down in the US, and that's another reason why the US market, housing market, is behaving the way it is there. So yeah, I think the next few months, housing will be a very, very interesting indicator of what's going on.
Yeah, I'm really curious to see what happens with auction numbers, because we've seen this really interesting set of circumstances where a significantly larger proportion of listings than normal have been heading to auction. So I'm curious to see, as we see this potential surge in new listings, if we see that surge in auction numbers, because that could give us a bit of a clue, an early sign as to whether or not the market is going to be able to absorb all that additional stock.
Yeah, very good point. I think that's going to be worth watching over the next two or 3 months. And Andrew and I have been chatting about this for some time, saying, well, the numbers are low, and therefore the clearance rates might sound reasonable, but volume-wise not particularly high. But if that changes, then who knows? We're certainly we're in unexplored territory in so many ways, aren't we?
Yeah, we certainly are, and I think we might be exploring new territories in terms of the duration of this video.
It's gone a bit long, but anyway, look, high quality conversation, Tarric. So definitely worth the candle, and I hope our audience enjoy the extended Friday afternoon, evening conversation, because at least it gives us a chance to sort of explore some of these things and integrate some of the ideas. Because that's, for me, one of the important things about these shows is we show how all the elements sort of fit together.
Yeah, no, it's something that I really enjoy, and it's something as well that I like. We get these questions and we're able to explore them in a little bit more detail with the aid of some of the charts and stuff, and really sort of paint a picture of how the sausage is made in terms of a lot of these different issues.
Absolutely. Well, we'll do some more sausage making in a couple of weeks. So I look forward to that. Thank you very much. Have a great weekend.
Yeah, thanks, mate. I'm looking forward to it.
See ya. Bye bye.
See you, mate.